Hello investors, welcome to Simpli Stocks. Small cap stocks have recovered well after bottoming out in early February. You will see that small cap index itself is up 7% from its low. From here on, whether the recovery will be gradual or sudden, it is difficult to say. But we are seeing early signs of recovery in the market. First, the US-India trade deal was announced, which gave confidence to the market. And then the results of some companies have also been very good. So they have boosted the sentiment as well. So now as the market is rebounding, it is a good time to focus on those companies or stocks that are trading at low valuations due to the correction. The intent here is that valuations are currently low across all the stocks, both good and bad. Therefore, when FIIs or other institutions will come back and the market recovers, quality business models with good growth will be in better position. That is why in today's video, we will talk about 8 low PE, high growth stocks from the small cap universe. We won't go into excessive details. My purpose here is to give you a direction so that you can study these companies yourself. And yes, keep in mind that this video is not a buy or sell recommendation on these stocks in any way. Please keep that in mind. With that, let's begin. The first business we will study is Interarch Building Solutions, which is in the business of making pre-engineered steel buildings for other companies and industries for their plants, warehouses, etc. PEBs are better than concrete buildings in many ways. They get ready quickly and are also cheaper. For example, the T3 terminal at Delhi airport is PEB. Similarly, manufacturing plants and hospital buildings can also be PEBs. Apart from this, you will see here that solar manufacturing plants and data centers can also be pre-engineered. Interarch is a direct proxy for industrial and infrastructure growth in India. Currently, this business is trading at a PE ratio of 24 to 25. Their results for the December quarter have been good. Sales have increased by 44% compared to the last year. It is expected that as tariffs have been decreased now, the companies will start their expansion again and set up new plants. So this business can do well in the near future or sometime after that. The next business we will cover is Zaggle Prepaid Ocean Services. This is also a portfolio stock of Ashish Kacholia. You will see here that he has 2.23% shareholding in it. Zaggle has corrected significantly from its all-time high. As far as I remember, it is trading at a discount of almost 50%. About 1.5 years ago or 2 years ago, when IPOs of many tech companies came out, there was a lot of hype and these companies traded at very expensive valuations. However, since then, they have corrected and the valuations have become very good. Zaggle provides apps, websites, or say software platforms to companies to manage their expenses. They have many products according to different use cases such as Zaggle Save, Zaggle Propel, Zoyer, etc. Now, because this is a tech business, margin expansion is happening here. One of the biggest advantages of a tech business is that as your platform development cost is one-time expense, once it is ready, after that, expenses don't increase at the same speed as your sales. So, profit growth is higher because your profit margins are expanding. Now, a growth of 40 to 45% is there in this business. This year, they are targeting 10 to 11% EBITDA margin, and in the next 4 to 5 years, the management is talking about taking the EBITDA margin up to 14 to 15%. This means that the sales growth is anyways very good here. But alongside that, we will see very good growth in the bottom line too due to this margin expansion. Zaggle's PE ratio is only 35 right now. It is at a good valuation for a tech business where such good growth is coming, and at the same time, margin expansion is also happening. After Zaggle, let us look at Chambal Fertilizers. Chambal has also corrected quite a bit and is trading at a PE ratio of only 9.5 to 10. As agrochemicals is a seasonal and cyclical sector, businesses here anyways trade at low valuations. But even then, a PE ratio of 9 to 10 is way too low. Now, Chambal is doing a capex of almost 1650 crore rupees for 2.4 lakh metric tons capacity of TAN or technical ammonium nitrate. TAN is used in explosives, mining, etc. The demand for fertilizers has been good this year. Moreover, there is a high chance that in the coming months, if the government does not approve new urea plants, the demand for urea might exceed the supply. So overall, from the demand side, the outlook is very good. Therefore, you can also look at Chambal independently. There is a good scope for PE re-rating here. Now, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Coming back to our discussion, the fourth business that is currently doing very well but is running equally undervalued is Yatharth Hospital. Yatharth is the fastest growing business in the entire hospital sector, and the December quarter, that is Q3, has been a breakout quarter for them. You will see here that this business had been growing in the range of 20 to 30% for a long time, but this time in the months from October to December, their sales have increased by 46% compared to the last year. The entire execution of the company, whatever new hospitals they were opening or they were buying other hospitals over the last 2 years, we are seeing that entire execution playing out very beautifully in front of us. Out of their 8 hospitals, the 3 in Noida, Greater Noida and Noida Extension are old mature hospitals. The remaining 5 are new hospitals that are now bringing good growth. Out of these 5, they recently purchased this new facility in Agra. Now in February, this has also come under the company. So with added revenue from the Agra facility, we will see even better sales growth in the March quarter results. Plus, with new hospitals, Yatharth has also diversified significantly. You will see that 4 years ago, almost their entire revenue came from these 3 hospitals in Noida, Noida Extension and Greater Noida. But now the risk and concentration in the business has decreased. In such a situation, the market will also gradually start giving Yatharth a premium PE multiple like other hospital businesses because its fundamentals are improving very rapidly. Therefore, you should study Yatharth independently once it is growing the fastest in the entire sector, and due to the recent correction, the valuation has become very attractive. Hospital companies anyways trade at premium valuations because they are asset heavy defensive models, but Yatharth is currently available to you at a PE ratio of just 37 to 40, and considering how fast this business is growing and in future too they can keep growing at 30 to 35% rate, so this is a good valuation. After Yatharth, let us look at Vintage as well. Vintage is a FMCG player and they make coffee for other brands or companies, and they are mainly export focused. Like Yatharth, Vintage's results have also been very good. You will see their sales increased by 71% from last year, touching almost 150 CR this quarter. Profit growth has also been very good. They currently have 6,500 metric tons of operational spray dried and agglomerated instant coffee manufacturing capacity. And another 4,500 metric tons capacity will start in this very March. This will increase their production capacity by 70% from 6,500 metric tons per annum to 11,000 metric tons. Then moving forward, the company is already planning for next year as well, and this is what I like about Vintage most. They are bringing in another 5,500 metric tons capacity ahead in Telangana. Roughly in the long term, over the next 3 to 4 years, their target is to have a total capacity of approx 16,500 metric tons. Therefore, we have a very good visibility for 40 to 50% CAGR growth here for the next 2 to 3 years. So Vintage Coffee is a good FMCG business that you should look at. The valuation is also very good. Currently, this business is available at a PE ratio of only 32. At number 6 and 7, we will talk about 2 jewelry companies, PN Gadgil and Sky Gold. PN Gadgil is a Maharashtra-based jewelry retailer like Titan and Kalyan. They are also in the business of selling jewelry through their stores. Speaking for Q3 results, sales of PN Gadgil's retail division have increased by a solid 46% compared to the last year. Gadgil has been a regional player so far, but now they are expanding pan-India like Kalyan. When Q3 ended, they had 50 stores, and by March 2028, their plan is to triple their stores by opening 100 stores from here, which will be a mix of their large format Gadgil and small format lifestyle stores. So you can study Gadgil independently once, as they are guiding for 20% sales growth for FY27. On the other hand, Sky Gold is your B2B player. It does the work of making jewelry for other jewelry companies in the market, such as Kalyan, Gadgil, etc. You will see their sales increased by 77%. and profit grew by 120% in Q3. Sky Gold is right now at 631 kg of jewelry every month, and from here, their long-term target is to expand and reach capacity of 4,500 kg of jewelry per month, for which they have also purchased 10,500 square meter of land in Mumbai. So he and Gadgil and Sky Gold are both very good fast-growing business models that you can study yourself once. You will see that both businesses are currently trading at P ratios of 20 to 25. Because what has happened is that due to the rally in gold prices, there has been a negative sentiment in the market regarding jewelry businesses. But despite the rally, jewelry businesses have continued to grow very well and they are giving very good results. And if you say that gold prices have rallied so much that people will stop buying gold, I don't agree with that. Because see, we Indians have a very different relationship with gold. We have looked at gold as both a status symbol and an investment tool for thousands of years. And look at it this way. The very fact that gold prices have rallied so much has further reinforced people's mentality. From this, people now have even more trust that gold is such a good investment and they should have done it or they should have bought gold. So in my opinion, people will continue to buy gold for the next 10, 20 or 50 years. Yes, they will gradually move downwards towards lower grammage and caratage, but long-term sector fundamentals are very intact. And because of this negative sentiment, all jewelry stocks are trading at good valuations. Now, moving forward, the eighth small cap business we will study is EFC India. EFC is in the business of office leasing. These people take buildings on rent, renovate them, and then they lease them forward to other companies as offices. They have 86 offices across 10 Indian cities like Delhi and Bangalore, where they manage more than 68,000 office seats. Apart from this, EFC is also in the business of interior designing for offices. They design offices and working areas for other companies. Similarly, they have a furniture manufacturing segment too by the name of Ek Design. This business was purchased a little while ago. A trigger that has come into this furniture business is that EFC's promoters have purchased Pepperfry through another one of their companies, sister company, TCC Concept. You might have probably heard about or seen Pepperfry furniture stores yourself as well. Through this acquisition, Ek Design will get a good platform to market its products across the country. So from a business perspective, the company has been performing very well. EFC is currently the fastest growing player in the office leasing business. This company is small in size, so the growth is good. But on the other hand, you will see that this business has remained sideways for a very long time now and is currently trading at a P ratio of only 25. These people are constantly adding more seating capacity in their office rental business. The management does not give guidance, but they have a target to add 20,000 seats every year or roughly say about 5,000 seats every quarter. One positive development in this was that in October, famous ACE investor Sunil Singhania also picked up a small stake in this business through his fund Abacus. So you can also study EFC once independently. Now at the end, I will say a lot of hard work and time went into making this video, and we are bringing all this analysis to you for free. In return, we are just asking for your support in the form of likes and subscribes. So if you support us by liking and subscribing to this channel, we will be able to bring more such videos for you and we will be motivated much more. So definitely like this video and yes, also subscribe to our channel. I'll see you in the next video. Happy investing.